Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we're taking another look at Estee Lauder. They had earnings late last week, and let's just say they weren't too pretty. The stock is selling way down. The last time we looked at it, it was in the 190s, and as of close of market today, it's just about $150. So it's slid $40 in the last 3 months, and we're going to take a look at why that is. And it's their Q4 earnings because they're on a slightly different financial calendar. So we have a whole year update and some projections going forward. So this is going to be a good one. We're going to try and make it pretty quick because this stock is not a buy. And I definitely understand why things are sliding. We don't need to get too deeply into the earnings. We have the headline information that we can make decisions based off of. I read through what the CEO said and their guidance, their report for the year, and there's really nothing in there that is going to benefit us in any way, unless it were to be a buy, and then we could really dig deeper. But right now, we're looking at what the numbers were the last time. A few months back, we took a look at the company. This 2023, 2024 are unchanged since then. So we're saying if they come in on expectations for this year, they'd be worth about $211 fair value, which means it'd be a good idea to buy under 179, and we'd want to reevaluate at 233. So has that changed? Uh, we have the numbers here. So we have our percent to that goal and their actual numbers year end. And we're looking at them coming in a little bit higher on revenue. That's good. But their cost of revenue was 21% higher than expected, which dragged down their gross profit and the margins. So their gross margin dropped about 5% from what we typically see from them. Definitely not something that we want to see, a margin trending down. 70 is still a very healthy margin, but we'd want to see that bounce back to 75, 76 come this next year's numbers. Total expenses jumped up as well. They were 11% higher than expected, which helped to drive up their expenses as a portion of their revenue to 90.52%, which drops their net margins down below 10%. We see they had a pretty small net income, 9.5% net margins, EBIT of just about $1.4 billion, and they came in at $2.81 in earnings per share. They were expected to come in at 339. And this is where we need to take a look at next year's numbers, because they came in 17% shy of the target. Now, we had gotten this number from analysts, and analysts have updated their numbers. And now the average expectation among 26 analysts for next year is $4.83. So before I hit enter, we see that next year's fair value is 295 based off the current numbers. But once we update this, that drops down $14 to 281. Now it's significantly higher than last year's and where the stock currently stands, but that is a pretty hefty drop of almost 5% in the total fair value. As we continue down, they were basically spot on shares. In fact, they bought back a bit more than expected. We expected them to end the year at 358.6. They ended at 357.9, likely due to the lower cost of shares because the stock is so beaten down, it just keeps getting kicked and stomped on. Common stock equity, they came in 6% shy of the target, and that is due to higher liabilities than expected. They came in with higher assets too, 3% higher, but the liabilities came in 6% higher. And that is not helping their debt to equity ratio, which is one of the main issues with this company is the debt. We refuse to buy stocks above 1 on a debt to equity ratio, and this stock has a 3. So they've got quite a bit that they have to do before it's really even reasonable as a value investor to be purchasing this stock. And they are light on cash as well. They came in 27% shy of the target on cash. They currently have $11.26 per share. We're expecting 15.42. Dividends, I'm not seeing a raise in their dividends. Uh, we're gonna hope that they come out with one this next quarter. But as of right now, over the course of the last year, they've paid out $2.64. And we were wanting 284, so hopefully they'll have a raise and we'll be able to see the dividend moving up going forward, because we were wanting 316 next year. And at the moment, with the information that I got, we can, it's almost looking like they're going to hold flat because they've been at the 264 for a little bit now. And with the lower cash flows, there might be some board members who don't really want to raise the dividend and just hold it where it's at. They only have 3 years of raises, so it's not like they're trying to protect anything, any sort of title. So after everything's said and done, we can move these over and see what the fair value is for the company off of how they actually performed as of today, and see, is the low share price today reasonable? 188.84 for a fair value, which means a margin of safety would be buying it 160 and a half, and we would want to reevaluate at 208 and a half. So the question now is, do we update next year's numbers aside from the earnings per share? Earnings per share we already updated. I threw in some 2025 numbers. I just made this stuff up off the top of my head, but I've worked in compound annual growth rates. We now have 4 years, 3 years, and 2 years. So we have quite a bit of data that we can look at and see what is going on with this stock and kind of make an educated decision on where we think that the stock is going to be going from here on out. So I will shrink all these so we can get everything in a good view. And then we'll make some projections. So the important numbers here are revenues, which will run through all the financials all the way down to earnings per share. And then the share count is incredibly important. The free cash flow is very important. And then the balance sheet is important. And that's what we use to evaluate the stock and get some intrinsic values. So they came in at 15.9 this year. Is the 25.55 for next year still reasonable? Probably not. In fact, analysts' current projections are for next year to be 17.2, which is significantly lower than what we had just seen. And we would definitely want to lower going forward as well. So we see over the last 4 years, they've been compounding 1.7, 3, 3.6, and then 2, -1. So they have been shrinking more recently. We're looking for them to come up off of their pandemic slump and grow. That's something that they did mention in their earnings report. They are still blaming the pandemic and shutdowns, and specifically Asia, on its slow reopening. So I think we can go on more of the middle end here on revenue growth and say, what if they're able to come in at 17.2 this next year and continue with another 1.7 in growth for the following year? Let's see what that will give us. So we will go with one of the middle cases on that of 1.7% growth, which is low. We do want higher when we're looking at buying stocks on this channel. And then earnings per share, we're going to take out this manual 6.5 and just see if we take next year's analyst expectations, and they're all over the place on their growth. Yeah, their inconsistency is insane. They've gone from 4.9 to 1.9 to 7.9 to 6.6 to 2.8, and Now they're gonna go to 4.8. So I don't know. 5 might just be a good based on the trend. They might even go lower than that. And then here we're taking the higher case. Let's take the one of the middle case, 0.4% buyback rate. And next year we'll take the higher case because the stock is so low at the share price right now. Free cash flow. This is just based off the free cash flow yield, where they typically are coming in 11.5%. We see a lot of numbers coming in around 11. Even this year, they came in just shy of 11. So we can almost assume that 11% free cash flow yield, asset growth towards the lower end. It's been slowing down, 15.83. Liability growth, that's been picking up. It went from 18 to 2 to 6. So we'll go with the 6. And then that will give us everything we need to calculate the valuation. So in that case, we'd be looking at a fair value of $270, almost flat. A buy, so the margin of safety would get us 229.5, and then we'd want to reevaluate right around 300. So how does that compare to this year? Significantly better. It's almost $100 higher on the fair value. The margin of safety is $60 higher, and then the point to reevaluate is also almost $100 higher. So given that, if they can get back on even the medium trend on what we've been seeing from the stock, they are worth significantly more. They're almost half the value, but that's an if, a big if. They need to deal with that debt, and that debt might slow them down on that pace. But that's what we're looking at for the stock. So it's definitely not a buy, especially with a 3 debt to equity ratio and some inconsistencies across the board. Another thing I wanted to touch on is this ROE. We're looking for an ROE of at least 20. The expectation was 31.9, and they would come in at the end of the year at 27.2. But because the return on equity uses the shareholders' equity, and the shareholders' equity is heavily dependent on the debt, a company with high debt such as this is going to show an abnormally high ROE. So instead of using shareholders' equity, I want to say strictly upon the assets that they have. I mean, this isn't a good valuation either, but you'll see how much it switches without taking out that $17 billion. They're actually like on their assets on their balance sheet. They're getting all the way to the bottom line of their financials, 6% return on those assets. So that is pretty low. It is clearly being propped up by their debt. So I wouldn't say that 32% they were expected to get this last year was a very good measure. It's definitely somewhere between 6 and 32 that the true value of their returns actually lies. But so I want to thank you guys for watching. Please like if you enjoyed the video, comment if you disagree with anything. What are your projections for the stock? Do you think that they're going to come in better, worse than that middle case or what we projected out? And subscribe so you can stay up to date. This is a stock that we follow pretty close because you guys seem to enjoy it, and it's one that I've looked at in the past, and they definitely have great margins. So we'll see if they're able to maintain them and how things go in the future.